Welcome back to the Gray Report. My name is Spencer Gray, president of Gray Capital, and I'm joined once again, director of communications and marketing here at Gray Capital, Dr. Matt Bosnagel. Matt, how are we doing today?
Pretty good.
Matt, CPI came out. Fortunately, it was this morning. We have time to look through it. Maybe we've got a deal going on. Maybe we're trying to lock some interest rates. So maybe I was paying a little bit closer attention than some of them. I pay pretty close attention to all the CPI prints, because we typically do see rates move around the announcement. A little bit of relief. Yep. Inflation is not as hot as some people were fearing, thinking that tariffs are going to really seep into the system. There's a little bit of evidence of that, but it looks like the biggest driver of inflation is shelter and housing, which we know is a little bit weaker than the CPI is actually printing. So the index came at 2.7, anticipated was 2.8. Core, though, increased from 2.9 to 3.1. So cooking a little bit hotter, but it's not a worst case scenario. Yep. We're kind of almost in this Goldilocks zone, because we're all anticipating potential rate cuts later on in the year by the Federal Reserve. I think the probability now is 85% for there to be 2 rate cuts in 2025. And this CPI report set it up for that to be a possibility. We've got a Jackson Hole speech in 10 days. Yep. They're going to give us a little bit of insight and kind of that nuanced opinion of what they're thinking. What was your reaction to the CPI report, Matt?
I think it was a little bit boring. I think it was essentially flat, maybe a little higher, a little lower. I wrote down, I was writing here, you can find your own worldview supported in these numbers if you want. If you're looking and you want to cherry pick something that seems like inflation's going down, then you can find that in there. If you want to find areas that are going up, like there's used cars, household furnishing, medical care. Those are some of the categories of price increases. You could say, oh, used cars, well, it's because of those tariffs. Or
the used car tariffs?
Well, the used cars are making the imports that are expensive, and then the used cars is it's a trickle down tariff pricing effect, I think. But if you're willing to make that, I think that there has not been any kind of dramatic price increases related to tariffs. Are
you thinking we're going to still see that? I mean, you would think that there would be some. It would show up maybe a little bit more, but we're just not seeing evidence of it.
Yeah, I'm completely unsure right now. I think that I don't even know how much tariffs are being paid right now, or if they are going to be, or if they're delayed. Like, it just seems like what it's done is create uncertainty, and it hasn't necessarily had an impact yet on imports. We're still waiting. I think those headlines, you were mentioning some headlines that were like, this is it, that proves it, that's tariffs are inflating prices, that's it, this is it. But,
the New York Times, the headline was, tariffs finally show up in the CPI report, the hot CPI report, and then they're core inflation is up 3.1%, the highest reading we've seen in 5 months.
Yeah.
I'm like, 5 months?
Yeah.
5 months? And I was like, so then year over year, it was higher under Biden. And I'm completely ignoring, you're going to highlight whichever statistic kind of fits your narrative. And not a fan of tariffs. I think we would have less inflation if there weren't tariffs.
Yeah.
Now, but there's also the cool down effect from the uncertainty of tariffs that happened also.
Yeah,
so there's all these counterbalancing forces that are going on. There's also this idea out there that a lot of folks that are selling into the U.S. market want access to the U.S. market, and so they're cutting some of their pricing, or they're at least reducing their margins a little bit, still making money but making a little bit less, but they're still being able to sell to the U.S. Who knows? I think we still could possibly see some, but right now it looks like we might see some Fed rate cuts, especially if we get some jobs reports. We've got some more jobs reports before those announcements. If we see a continuing weakness in the economy, specifically with jobs, I think they're going to do, basically a maintenance cut. I don't think they're going to say that the economy is in free fall, but, the neutral rate has moved, and we need to, move the Fed funds rate, the policy rate, down accordingly to at least be neutral, where they're saying today that it's purposely restrictive.
Yeah.
So they'll move out of restrictive territory to a neutral territory, not necessarily needing to be fully accommodative.
Yeah, no, I think that makes sense. I think that there's, even though I've spilled a lot of ink writing all these notes on investors are finally getting used to persistent elevated rates, I think we're in a restrictive element right now. And I think that there is no possibility that rates are going to go back to zero short of a world-altering pandemic or something like that. But come down to maybe 3 or 4 is would help kind of.
I mean, the reality, again, we have the most insight into multifamily rents, and so I can't necessarily speak with certainty on every area of the economy. But I mean, we have seen we talked about this last week. We've seen a weaker multifamily leasing season, this year, and so when we're not seeing high growth rates, those high interest rates are absolutely restrictive, and they are more restrictive relative to where they were last year, because at least last year we had a little bit of higher growth rate. We had a not a normal leasing season, but we didn't see the fall off in May, June, and July that we saw this year, where we were expecting to see some really strong growth in May, June, July. Because what hasn't stopped some of that expense growth, is still there. There's expenses are higher year over year. Not as bad as it was. We're not seeing the huge insurance increases, but again, it's there's only a few assets in our portfolio where we've been able to significantly reduce expenses year over year. Everything is either kind of flat or elevated a little bit. Yeah. And and I've heard this from different sponsors, investors across the board, this idea of NOI stagnation, net operating income stagnation, of where you're maybe getting some rent growth, but expense growth a lot of times due to uncontrollable things like insurance, like property taxes, is eating into that growth. And so when you look at an elevated interest rates, it doesn't help the situation at all.
Yeah, I think that's probably the case, because I have read a couple things that have said, I think there was something in Yardi Matrix's last report actually that noted that expense growth was coming down, but when rent growth is below normal, you're not going to notice it as much.
Well, so, expense growth goes from 4% down to maybe a normal 2, or maybe it's still at 2.5. But if your rents are growing by only 1%,
then it's tough.
So good, and rents are growing higher than that in many markets. I mean, they're growing higher than in our portfolio, but again, property taxes go up by 30%. Yeah. There's only so much you can appeal, but it takes time.
I did want to note too, and because I was thinking about this as you were talking, and I should have noted it even last year. Unemployment has been a persistent concern. That's something that we were tracking even last year during the Biden administration. It has been on this long trend downward. We used to really talk about, and it was true, there was a undersupply of labor, and now we're getting close to, it's kind of gradually decelerating, the drop in employment, but it's still, this is a longer term trend than just a couple of months. Even if we cut out the revisions and we just went with a kind of longer term trend that was going on from 2024, then unemployment could be kind of approaching a little bit scary levels somewhere in the future. But we're still, again, all things considered, unemployment is still well within levels of normal.
Yeah, 5% I think is typically viewed as like a healthy level of unemployment rate. We're still below that. I think we're at 4.2, 4.3 today. Something like that on a national level. I mean, the Great Recession, I think it peaked around, with 10%, 8, 9, 10%, I think. I mean, that's where it's like, okay, that's troublesome. We're so far away from that. Yeah. But the trend is potentially concerning if it hits that, 5 handle and keeps on going. Yeah. You have to ask, what's going on here?
Yeah, yeah. You did note the how much of a factor shelter was in inflation. Yeah. And we have the details down here, and I'll scroll down to shelter, and we can kind of see the breakdown. And maybe we can talk some smack about how CPI's measurement is not a completely current reflection of the market, but I think they're measuring something different.
I think they're measuring. We were having this conversation before the show, and I was like, we need to get Mr. Chapman, John Chapman on, who's our data science associate, to kind of help to try to explain in somewhat simple terms. And we've done it so many times on this show, and we've broken it down. But it's more that it obviously doesn't reflect the reality on the ground, but it's in real time. But it's being used to reflect the reality of inflation in real time on the ground.
Yeah, like
because it's a third. It's 35% of CPI.
Yeah, and there's talk and complaints of they don't measure home values; they measure owner's equivalent of primary residence, which is a survey that goes around and says if you were to rent your home, how much would you put it to rent? And that's what they use to measure home prices. They don't measure the home price themselves, partly because I guess there's like a capital investment aspect of home prices that they don't want to get involved in. They don't want to measure that. They just want to measure kind of housing as a service, and that's okay. But the question is that going to be useful? It's going to be useful to you as a realtor if you are, if you're a real estate agent and you're trying to sell your homes to get the CPI number, or do you go to like Case Shiller? So I think that this may be useful for some kind of government use where they figure out what people are renting and how much of an impact it is on their day-to-day life, and that's their measure of inflation. But for other people, for other uses, if you want to figure out what the market rents are, which is much more up to date and is much different from it's far ahead of what is in the CPI. If you want to measure market rents and you want to know when money changes hands, what the price of rent is, you should probably look to private sources. So it is measuring something different. I do think though that it is too flattening. That's kind of my issue. Is the CPI measures, it takes away the volatility almost like by design. It seems like, as some of the justifications that I've heard. I'm like, I kind of want that volatility to still be in there because it just I don't know.
Well, you can always strip things out, right? I mean, that's what they have core and and there's super core as well, which strips out shelter as well.
Or do you want to go to the
wherever you want to go? All
right. So, you can see that core has gone up, and it's gone up a little bit. But I want to look here and just get some top line
3.1.
Some top line numbers about shelter. Shelter is up 3.7% compared to last year, and the rent of primary residence is up 3.5%, and then the owner's equivalent of rent, which is basically home prices, I guess, is up 4.1%. So right now we are at 3.5%. How much? That's elevated above the 3.1% up for all items. And I'm sorry, that's just core inflation. If all items inflation is 2.7, then that 3.5% for rents, that's going to push it up. But we know, based on market rent, that still has room to go down. The question is, and I even was asking this when rents initially popped up.
Well, an owner's equivalent of rent is 4.1, and it makes up 26%.
Yeah. So and I
well above the 2.7.
Yeah, housing is such a big skew, and I also think that owner's equivalent. There was an article in Forbes that I found that was arguing against owner's equivalent of rent because in the same way as apartment rents are lagging, owner's equivalent of rent it lags behind current home prices. And by like 6 months or so, they may get to an accurate price, but because these owners are not putting it on the market at the moment, they're just behind. And that information they're gathering from their survey when they're asking that question is 6 months, 9 months maybe behind current values, and that could mean, and I think it really does mean, that it's not capturing the softening in home prices right now.
And again, I don't think we have super core, but I mean, again, just stripping shelter out, inflation all of a sudden is like at target, closer to 2%. Mm-hmm. And so then again, why this is important beyond looking at what are the impacts of tariffs on the economy is what's going to happen with interest rates, what is the Fed funds rate going to be, and how that will impact longer term rates. And the folks at the Fed, they're smart. Maybe they don't always make the right decisions, but they're aware of all of this. They know that inflation has cooled down significantly.
I think that that above all, you do illustrate the stakes of and the need for good, accurate information, because this is right in front of us what the government uses to make a lot of its decision. Now, again, you said Fed's smart people, but like these are the numbers that a lot of people, I'm sure that there are many government expenses that are tied specifically to the CPI.
That's true. Yeah, and a lot of things are tied to the CPI.
And so that means that like we better have a good assessment. And it kind of moves into this other topic of, well, is this going to are we going to get to the point where, not because of structural reasons, but because of maybe political reasons, that we can trust or not trust the BLS? Is every 4 years it going to be different? I'm a little bit unsure. And it just doesn't look good because also, aside from any politics thing, people aren't answering their surveys anymore. Did I reference how I want to make it mandatory that you fill out the surveys?
You told me, yeah.
Yeah, well, I wish they did. Because people aren't filling out the surveys. They put out 60,000 individual, 120 business-related surveys. And I'm, sure probably some of them are on the internet. But I bet a lot are in pencil and paper.
I better fill out the survey for the Ministry of Truth.
Yeah, and people aren't doing it though, and that's a big problem here and in other countries. And there are things that the surveys can capture that you can't get through other technological sources. They're working on different ones. I still think that's a big problem. No matter what. That means that the data has gotten probably harder to gather, probably more expensive to gather, and so it's just going to get worse until until they figure out something, which I think should be a law. You have to tell everything. You have to come up with hook your credit cards up to the government, and you have to fill out a form about what you spend and how much money you spend every day. And then we'll get some good economic information. Slight sacrifice to privacy, but
okay, Elizabeth Warren.
Yeah, sorry.